Today, the big inflation joke. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, there's a tale of two CPIs today, the USA and China. The former showed a slight fall from very high levels, the latter reporting the highest since July 2020, as pork prices jumped 20%. In both places, central banks warn they cannot drop their guard on controlling the inflation dragon. And yet, economists are already talking about a downtrend in the US. Well, we'll see about that. In contrast to the US and other major economies, consumer inflation in China has been relatively subdued this year as strict COVID control policies and sporadic outbreaks curbed consumer and business spending. Those virus flare-ups, along with global headwinds and an ongoing real estate crisis, has kept China's economic recovery fragile, with factory activity unexpectedly contracting last month and property sales continuing to shrink. And China's authorities have already signalled a willingness to let the CPI creep somewhat higher. If we can keep the unemployment rate below 5.5% and the CPI stays under 3.5% for the whole year, we can live with a growth rate that is slightly higher or lower than the target. Not too low, of course, said Premier Xi Jinping at an event with business leaders hosted by the World Economic Forum last month. Now in the US, inflation deaccelerated in July by more than expected, reflecting lower energy prices, which may take some pressure off the Federal Reserve to continue aggressively hiking interest rates. That's what the market thinks at least. The Consumer Price Index increased 8.5% from a year earlier, cooling from the 9.1% June advance that was the largest in 4 decades. And that was from data from the Labour Department. Prices were unchanged from the prior month, and the decline in gasoline offset increases in food and shelter costs. The so-called core CPI, which strips out the more volatile food and energy components, rose 0.3% from June and 5.9% from a year ago. The core and overall measure came in below forecast. Now, of course, much of this is the base effect, as higher rises a year ago drop out of the measure, and it's still way above the Fed's target. I suppose, though, the data may give the Fed some breathing room, and the cooling in gas prices, as well as used cars, does offer some respite for consumers, but annual inflation remains high at more than 8%, and food costs continue to rise, providing little relief for President Joe Biden and the Democrats ahead of the midterm elections. While a drop in gasoline prices is good news for Americans, their costs of living is still painfully high, forcing many to load up on credit cards and drain savings. And after data last week showed still robust labour demand and firmer wages growth, a further deacceleration in inflation could take some of the urgency off the Fed to extend outsized interest rate hikes. In fact, Treasury yields slid across the curve while the S&P 500 was higher and the dollar plunged. Traders now see a 50 basis point rate increase next month as more likely than 75. This is a necessary print for the Fed, but it's not sufficient, Michael Pond, head of inflation market strategy at Barclays, said. We need to see a lot more. Fed officials said that they want to see months of evidence that prices are cooling, especially in the core gauge. They'll have another round of monthly CPI and job reports before their next policy meeting on September 20th and 21st. Gasoline prices fell 7.7% in July. That's the most since April 2020, after rising 11.2% the month earlier. Utility prices fell 3.6% from June, the most since May 2009. Food costs, though, climbed 10.9% from a year ago. That's the most since 1979. And used car prices decreased. With rents still pushing higher and elevated wages beginning to seep into services inflation, we expect this pause could be short-lived. Core CPI could approach 7% in the coming months, despite our assumption of moderation in goods prices. And shelter costs, which are the biggest services component and makes up about 1/3 of the overall CPI index, rose 0.5% from June and 5.7% from last year. That's the most since 1991. That reflected a 0.7% jump in rents of primary residents. Hotels, meanwhile, fell 3.2%. And elsewhere in leisure, airfares dropped 7.8% from the prior month. That's the most in nearly a year. While prices are showing signs of moderating, there are several factors that risk keeping inflation high. Housing costs, of course, is the big one, as well as unexpected supply shocks. And wages are still climbing at historically fast paces, concerning some economists of a so-called wage price spiral. But those gains aren't keeping up with inflation. A separate report showed that real average hourly earnings fell 3% in July from a year earlier, dropping every month since April 2021. We're seeing a stronger labour market where jobs are booming and Americans are working, and we're seeing some signs that inflation may be beginning to moderate, Biden said after the report. He cautioned, though, we could face additional headwinds in the months ahead, citing the war in Europe, supply chain delays, and pandemic-related disruptions in Asia. The impact of inflation on wages has started to dent spending, with the pace of personal consumption growth deaccelerating between the first and second quarters. That said, consumer expectations for US inflation declined sharply in the latest survey by the New York Fed, suggesting Americans have some confidence that prices will come off the boil in the next 1 to 5 years. The data suggests that inflation has passed its peak, Commerzbank said, as the collapse in the price of gasoline plays a decisive role. But others, however, believe that inflation may still surprise to the upside in the coming months as oil prices are yet to peak. I wouldn't be in the camp that thinks we're at peak inflation, Sean O'Hara, president of Pacer ETFs, said in an interview. We haven't fixed the supply chain problem, and I don't think we've seen peak oil for this year yet. As a result, those stocks did surge on those softer than expected inflation data points, and it's fueled bets that the Federal Reserve could pivot to a smaller hike for rates, but a view taken with a grain of salt by many market watchers, saying officials may still be a long way off achieving their goal. Nevertheless, traders went risk on Wednesday, with the S&P 500 hitting a 3-month high. A rally in tech shares sent the Nasdaq 100 more than 20% above its June bottom, leaving it in a bull market, going by that commonly held definition. The gauge still sits, though, 19% below its November record, and the volatility index slid to a level last seen in April. Google parent Alphabet and Meta led the gains for big tech, while Apple and Microsoft were up by more than 2% each. Twitter, meanwhile, gained about 3% on bets that the social media giant may win its legal battle with Tesla chief executive Elon Musk to force the billionaire to complete his $44 billion deal to buy the company. Tesla climbed after Elon Musk offloaded $6.9 billion worth of stock in the electric vehicle maker to accumulate cash ahead of a trial that could force the billionaire to follow through on the agreement to acquire Twitter. The Tesla CEO sold nearly $7 billion in Tesla shares over the past few days to, quote, avoid an emergency sale of Tesla stock should Twitter force the deal to close. The chances of a Twitter deal now are more likely, Wedbush said, and raised the price target on Twitter to $50 from $30, reflecting the higher chances the deal now will ultimately close. Elsewhere, Wendy's became the latest restaurant chain to show signs of strain thanks to rising inflation, as sales and restaurant margin fell short of Wall Street projections. And after the close of regular trading, Walt Disney said it would raise the price of its flagship Disney Plus streaming service by 38%. That's part of a plan to generate more revenue for its money-losing online businesses and build on third-quarter results that beat estimates for sales, profit and subscriber growth. The shares jumped. Financials, mostly banks, were also in ascendancy as the Treasury yield curve steepened, though it remained inverted, pointing to ongoing fears of a recession, albeit a milder downturn somewhat, following the latest inflation data and strong jobs report last week. Signature Bank, Synchrony Financial and SVB Financial Group were among the biggest gainers, with the latter up more than 7%. And in earnings news, Coinbase Global climbed 7% as the crypto exchange operator's wider than expected loss was overshadowed by a jump in Bitcoin, which was last at 23,802, and Ethereum jumped 8.4% to 1,847. The dollar sank the most since the onset of the pandemic. Treasury 2-year yields were lower by about 5 basis points in late trading, after plummeting nearly 20 basis points immediately after the data. The 2-year Treasury yield over the 10-year yield steepened to negative 40 basis points, following a dip to lower than negative 50 points intraday. Oil prices rose on Wednesday, rebounding from losses earlier in the session, helped by encouraging figures on US gasoline demand, and as lower than expected US inflation data drove investors into riskier assets. West Texas Intermediate crude topped $91 a barrel, while Brent crude was at $97.05. US crude oil stocks rose by 5.5 million barrels in the most recent week. The US Energy Information Administration said that was a more than expected increase of 73,000 barrels. However, US gasoline stocks fell sharply as implied demand rose after weeks of lackluster activity during what is supposed to be the peak summer driving season. Everyone has been very much focused on potential demand destruction, so seeing implied demand showing an outsized rebound for last week has probably given some comfort to those really concerned about that, said Matt Smith, lead oil analyst for the Americas at Keeper. Gasoline products supplied rose in the most recent week to 9.1 million barrels per day, though that figure still shows demand about 6% down over the past 4 weeks compared with the year-ago period. A rise in risk assets, including equities, saw the US dollar fall by more than 1% against a basket of currencies. With most worldwide oil sales transacted in dollars, a weakening greenback is supportive for oil. However, crude's gains were modest. Gold was at 1,806. For a market plagued by fears about the Fed's struggle to tame the inflation beast, the July Consumer Price Index did bring some sort of relief, with both core and overall measures coming in below forecast. Swaps are now suggesting a move of 50 basis points is more likely in September, rather than the 75 basis points that officials had opted to implement over the past 2 meetings. This is overly good news for risky assets, wrote Florian Lepo, head of macro at Lombard Odier Asset Management, adding that a lower growth rate of prices does not mean the end of inflation, and naturally the end of hawkish central banking. Inflation remains a situation that requires the Fed's intention and, more importantly, the Fed's measures. One danger of the stock market bullishness right now is it could cause a relaxation of financial conditions that would go against the Fed's goals. It's also worth looking back to the early 1980s, when the then Fed chair Paul Volcker eased policy as inflation peaked and the economy tipped into a recession. But the moderation of price pressures proved to be much slower than officials wanted, and they had to tighten again just a month later. In fact, the CPI surprise is just one of the pieces of the intricate puzzle officials are playing with at the moment, and possibly over the next several months, with the central bank still miles away from reaching its inflation target. Food prices in the US soared the most since 1979 July, keeping the cost of living painfully high, even as lower gasoline costs offered some relief to consumers. 2 Fed officials responded to softening inflation data by saying it doesn't change the US central bank's path towards even higher rates this year and next. Alluding to market pricing of the policy trajectory, Fed Bank of Minneapolis President Neil Kashari said it was not realistic to conclude the central bank will start cutting rates in early 2023. His Chicago counterpart, Charles Evans, said officials will probably continue hiking into next year to bring down, quote, unacceptably high inflation. The easing of financial conditions likely annoys the Fed, and we should not be surprised to see Fed speakers continuing to try to talk down the market and risk assets, said Christian Hoffman, portfolio manager at Thornburg Investment Management. The Fed still has significantly further to tighten them, and the US economy ultimately cannot avoid its fate. Enjoy today and the next few weeks. It won't last for very long, said Seema Shah, chief global strategist at Principal Global Investors, said. This data point will fuel talk of a policy pivot, but for me, the issue really does boil down to the labour market. Wage growth is running red hot, and absent of a turn around in productivity, this will ultimately fuel higher prices, wrote Neil Dutta, head of economics at Renaissance Macro Research. This is a step in the right direction, but keep in mind we have many miles ahead of us before inflation normalises. 1 month data point does not make a trend, however, so cautious optimism is likely the name of the game, said Mike Lohengrat, managing director at investment strategy at E-Trade. Wow, finally the anecdotal evidence that inflation was easing has finally showed up in a mainstream inflation report. The Fed is rapidly losing its case for further tightening, and this report reinforces for investors that either a new easing cycle has already begun or we're just very close to one, said Jim Paulson, chief investment strategist at the Leathhold Group. So you can pay your money and you can take a choice, because analysts are completely split on what's going to happen next. I think the recession story probably has more to run than the other, but there you go, we'll wait and see. Meanwhile, the People Bank of China said it will safeguard the economy against inflation threats, pledging to avoid massive stimulus and excessive monetary printing to spur growth. The central bank will both support economic growth and ensure stability prices, the PBOC said in its quarterly monetary policy report released on Wednesday. At the same time, it will provide stronger and higher quality support for the real economy, it said. Structural inflation pressures may increase in the short term, and the pressure of imported inflation remains, the PBOC said. We can't lower our guard easily. The PBOC's warning came on the same day official data showed inflation accelerated in July to 2.7%. That's the highest level in 2 years, largely driven by food prices as pork costs surged. Weak consumer demand kept overall price pressures in check, though. The central bank said consumer inflation will likely exceed 3% in some months during the second half of the year, but China will likely achieve the target of keeping full-year inflation around 3% in 2022, thanks to measures taken to ensure grain and energy supply, as well as a prudent monetary policy, it said. The PBOC signalled in the past that it will focus on boosting credit instead of cutting interest rates to support the economic recovery, while top leaders have raised concerns about potential inflation spillovers as prices soar in other major economies. The central bank said on Wednesday that factors that have contained inflation over the last 2 decades, such as globalization, have reversed, and the recovery in domestic consumption may accelerate the transmission of factory inflation to consumers. And China's reliance on imported gas and oil also created challenges, it said. Soaring inflation in the US and Europe is a lesson for China's macroeconomic policies, the PBOC said. Maintaining a stable currency is the primary responsibility of a central bank, and keeping stable inflation is key, it said. You could take that as a sideways glance at the US, I think. Acknowledging the tightening in monetary policy elsewhere, the PBOC said its unchanged policy interest rates in the second quarter have, quote, helped maintain internal and external balance against the backdrop of interest rate hikes by major global central banks. But finally, down here in Australia, Westpac said that for the FOMC, the July inflation report is, quote, a pleasing first step towards being able to claim victory over inflation. However, at least 1 or 2 more similar readings for inflation are necessary if they are to have confidence the inflation emergency is passed. A further decline in inflation expectations among households and market participants in coming months would assure the committee that they can go on hold at what members perceive to be a modestly contractory stance for policy, they say. And they went on to say, in our view, this is most likely to be a Fed fund rate of around 3.375%, achieved after a 50 basis point hike in September and a 25 basis point hike in both November and December meetings. As long as momentum in non-farm payroll employment remains solid to strong, a stopping out of the rate hike cycle before 3.375% is hardly unlikely. However, persistent weakness in spending and inevitable material deacceleration in payroll growth will justify 125 basis points of rate cuts from late 2023 once inflation is much closer to the FOMC's 2% per year target. So the joke is this. Both in China and in the US, inflation is a problem. In China, inflation is going up and they're happy to live with a higher level of inflation for currency stability. In the US, inflation is way too high and now the market is split between those who think we've turned the corner and those who think we haven't. And the truth is, nobody knows. So the joke is on everybody because inflation is unknowable at the moment other than it's too high. And because it's too high, you've got to expect more rate hikes, certainly in the US and probably here in Australia and in other Western economies around the world. Inflation is way too high. It needs to come back. But the question is, of course, at what point will they turn turtle and run for the hills? That becomes the question of the moment. So the joke is actually on everybody, and inflation is ruling the roost. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.